Dear viewers and listeners, I salute you all. I'm Nathan, a chartered accountant from Fenlina Management Consultants, Pretoria, South Africa. You are warmly welcome to this program geared towards preparing you for examinations in a more focused manner, saving valuable time, increasing your chances of passing, and making you highly knowledgeable. The model answers I give should not restrict you from using your own discretion. They are also more detailed than what may be required in the examination. The intention is to clearly explain in detail all the gray areas, leaving no stone unturned. Students aspiring to be chartered accountants find this program very useful. You may not have covered some of the areas being explained in your previous studies. Don't look at it as a limitation. With an inquisitive and positive attitude, you'll be able to understand, even if what is being explained is not part of your syllabus, there's totally nothing wrong with that because you will find them anywhere in your future papers. You may have already realized in your previous exams that a quick analysis of the requirements of the question goes with practice and exposure, which in turn makes a huge contribution to your time management. Experience has shown that the more questions you attempt, the more knowledgeable you become and more competent you become. Note that you are supposed to have read through the question and understood the requirements before attending or listening to this lecture. I have included steps that make my explanation easier to follow, but may not necessarily be required for examination. I have gone further to make additional notes on the side to make it easier for you to systematically follow my explanation. Below is a detailed breakdown of the examiner's answer. In this lecture, the question under scrutiny is from the exam paper ACCA Performance Management, sample CBE first question, September-December 2019. In this question, Yumi company owns restaurants in many rural locations, earning loyalty due to limited competition. It has been profitable but low margins, creating a necessity to constantly monitor costs. One of the restaurants, Coley Restaurant, has experienced a significant increase in customer numbers. However, there is now a new competitor, and therefore the need to revisit its business activities to remain profitable. At the beginning of the year, management receives annual budgets from head office and split them into monthly targets. Head office sends a monthly statement comparing actual performance against the budget. Students are required to prepare a flexed budget and explain the weaknesses of the current monthly performance report. In addition, they are required to discuss whether an incremental budgeting approach would be appropriate. The last requirement is to define the participative approach to budgeting and the potential advantages and disadvantages of introducing this approach. In the performance report from head office, comparison is made of the actual costs with the budget, ignoring the effects of the change in the actual number of customers versus the budgeted number of customers, which definitely impacts the variable element of the report. We start by recalculating the budgeted revenue per unit and each of the variable costs per unit. Then multiply each of these figures by the actual quantity, which is in this case the number of customers, to arrive at the flexed budgets in order to compare revenue and variable costs relating to the actual output of 1,800 units. A comparison can now be made by subtracting the flexed amounts from the actual amounts, arriving at favorable or unfavorable variances. When added together, we arrive at a contribution of 1,350, which is favorable. In other words, the revenue per customer is 50 times 1,800 becomes 90, which is our flexed revenue on the 1,800 customers. Then for costs, you do the same. You get the 22500 divided by 1500, you get 15. Then multiply by 1,800 to get 27,000. The figures that you see here are a result of getting the revenue and cost per customer multiplied by the actual number of customers to arrive at the flexed budget. Then we are able to compare like with like, because now our actual is based on 1,800. Therefore, our flexed budget of 1,800 compares correctly with the actuals of 1,800, giving us the figure that we see in this table. And then when you capture the variance, you're going to say actuals minus flexed budget. In this case, we get 2,700, which is the adverse, because we are expecting 90,000 for 1,800 customers, but we got 87,300, which gives us an unfavorable variance. We do the same for food and drinks, for staff wages, light and power, and you arrive at this figure, giving us a favorable total variable cost of 1,350. Then we go ahead. We look at the rates, which are fixed. In this case, because it is a fixed cost, we just calculate the actual minus the budget. Because here we don't flex, and therefore we are going to get 12,600 minus 12,000, giving us 600, an adverse situation, because we spent more than what was budgeted. Then we go down and get the sum of all the variances, which will give us 1,950 adverse. So our profit is supposed to be 4,200 based on the flexed budget, but it gives us 2,250, which is an adverse situation of 1,950. The next question is about weaknesses in the current performance report as a basis for performance management. Remember, the performance report was based on actuals compared with the budget of 1,500 customers. The actual is based on 1,800 customers. So there's no comparison between like and like. So in other words, the original budget was not flexed, which allows overspending of 72,450 minus 61,500, which gives us an overspending that we have overspent in terms of variable cost. The performance report shows overspending on all the costs, which is actually totally misleading. If you look at all the costs, they are all overspent. The actual customers are higher by 20% from 1,500 to 1,800. So we must compare like with like. In other words, we cannot use the report that was brought from head office to look at and compare the performance, because both of them, the actuals and the budget, are not talking the same language. The budget is based on 1,500, the actual is based on 1,800, and therefore the budget, which has been flexed, allows a more meaningful assessment of the restaurant's performance to be made. So flexing gives a meaningful assessment, more reliable comparison, give more details about revenue and cost differences, and then possible reasons can be given. For instance, if you look at the revenue that was budgeted for 1,500 customer, the revenue per customer was 50. But now when you look at the actual, it was 48.5. That is by dividing the actual, which is 87,300 by 1,800, which gives us 50. So there's a difference in terms of the actual revenue per customer and the budgeted revenue per customer. The same applies to drinks and food, which had been budgeted at 20,600. The actual was 20,610 divided by 1,800, which gives us 14.5 instead of 15 as you look at the budget of 1,500. So taken together, with a reduction in the average customer spending, this might suggest that some of the items on the menu had been changed since the budget was originally set. Then another weakness is that there's an assumption of staff costs as purely variable. Yet, you'll find that in many of the organizations, staff costs will always have a fixed component, especially where we look at permanent staff. They are normally given a salary, and therefore we need to dig deeper to be sure that the staff costs are not actually variable, but they could be semi-variable. The same applies to fixed costs. They may not be purely fixed, but semi-fixed. So it is important to get into the actual figures and see if there's no way of splitting the semi-variable and variable component or the semi-fixed and fixed component. By treating these as wholly variable does not seem to be appropriate. Then the next question is to discuss whether an incremental budgeting process is appropriate for Yumi. The starting point here is the current year's budget and results. And then you adjust for any expected changes to arrive at the new budget. Then the advantage is that it is relatively straightforward. And it is appropriate for organizations that are operating in a stable environment. The incremental budgeting is appropriate for Yumi because on many of the sites, there has not been much change, and it has been operating for a long time, and therefore incremental budget may be appropriate. So you just adjust for a few changes like price increase, inflation, and then come up with an incremental budget. So in this case, if you look at Yumi company, it is more or less appropriate for Yumi. Involving the managers should help to make the budgets more effective and realistic. Local managers should have a better understanding of the business, the environment, the operational constraints, the customers, the market conditions. Because Yumi has a relatively well-established customer brand and customer base, it is a good approach. There is a disadvantage, however, that it does not provide any incentive to make operations more efficient or economical. In other words, it doesn't allow for digging deeper into the costs and revenues to make sure that in future there's efficiency, because we are just using the previous year's budget or the current year's budget to look at the year following. So if there has been any over expenditure in this year, we are not going to pick it up in the following year if there has been any over expenditure. So it perpetuates inefficiency into the next year. Such an approach seems somewhat inconsistent with a focus on cost control with Yumi, because in the question, there was an aim to reduce costs. So it is inconsistent with a focus on cost control, which is one of the organization's objectives. Zero-based or activity-based budgeting are more suitable to drive down costs because you look at the costs from the original point of view. Splitting labor costs in proportion to the number of customers, more realistic, and would enable us to understand the costs much more than the current situation of incremental budgeting. The last one is about defining a participative approach to budgeting and explaining the potential advantages and disadvantages of introducing this approach to Yumi. The problem is that there's no opportunity for managers to influence the budget. There is that element of trying to co-own the budget because it has been designed and made by the people themselves who are supposed to be monitoring the budget. Similarly, managers are more likely to be committed to achieving the budget if they have been involved in creating it. Not least because their involvement in the preparing of the budget should help to ensure that they feel the budget figures are realistic. Managers' involvement leads to commitment to the budget. However, it's more time-consuming. The top-down approach is more suitable to restaurants in a stable environment versus participative for businesses facing a period of change. Similarly, managers are more likely to highlight issues which will lead to a reduction in their budgets rather than ones which increase their targets. There is a possibility of managers setting easily achievable targets. The increase in number of visitors of colleagues could support an increased revenue budget or revenue target. The managers and their participation in the budgets could lead to the targets becoming less challenging. So there are advantages and disadvantages. But the bottom line here is that once we involve the budget holders, we are more likely to have a realistic view of the business. However, they may also decide to slack their budgets so that they can achieve or they can set easily achievable targets. This brings us to the end of this lecture. Thank you.